that actually help with credit counseling, budget counseling, and everything else like that if you need it. So I am Chris Mills with People's National Bank. What I will be doing is giving a overview of the whole lending process and into some specifics as well as what we look for credit wise, documentation wise, and the different type of loan programs that you may or may not qualify for, along with the down payment assistance and what the down payment assistance programs look for, because those are two totally different components. The lender giving you the loan, and then the entity, which is usually a HUD certified counseling agency or some type of agency giving you funds for the down payment. Those are two separate transactions that go together for the same loan. I'm going to keep everybody unmuted. Um, if you got any questions or something like that, you should just be able to um, ask me the question or anything else like that, or just type it in the chat room, and one of us will get to you eventually. But can everyone see my screen? You can see the screen? Okay. So, quick agenda. Basically, things we're going to go over. Why should you own a home? The cost of renting, financing the home, traditional loan options, and then our banks, what we call our portfolio, our loan option. It's building communities together. It's a loan program that is not based on credit score. If for some reason you can't qualify for our traditional type financing. The very first thing we will cover is why own a home. And why you want to own a home is called appreciation. So when you buy a home each year, your home should appreciate or gain in value while you pay down your mortgage and that mortgage balance decreases. The difference between what your house is worth and what you owe remaining on the mortgage is called equity. And that equity you can actually tap into. Okay, hold on. I see somebody trying to get in. Give me 1 second, y'all. Apologize. I heard it. Where did it go? There we go. Okay. Can you hear me now? You just joined? Okay.
Am I mute? Can you hear me? Am I muted?
No, you can speak freely if you want to.
Oh, okay. Well, I have background noise, so I'll mute.
That's okay. Can you see my screen?
I can. Historic 5-year home appreciation.
Okay, cool. So what we were just jumping into is talking about why you should buy a home, and appreciation is one of the main reasons why you should buy a home. It's a good way to pass generational wealth. So quick overview. When you purchase a home, you have a loan balance of the amount that you borrow and then the value of the home. So appreciation is each year your home goes up in value while each year your loan balance, which you owe, goes down. That difference between the two, or that middle ground, is called equity, and that is actual funds. Like if you were to sell, you can have, or if you were to refinance, you can tap into that money, pay off other bills, take money out to do home improvements, other things like that. So historically, in the St. Louis area, homes usually appreciate anywhere from 3 to 5% a year. So you can see from the chart from 91 to 2005, you can see it steadily climb up, and then everyone knows what happened when the bottom fell out. And even right now, the market is what they call a seller's market, meaning there's more people wanting to buy homes than there are homes actually to buy. So once you get approved and you go start shopping for a home, you will find that once you find a home, number one, it's probably off the market really quick, or number two, that it's going to have multiple offers on it at the same time. So you kind of really want to know your numbers and what you can do, what you need to ask for, if you need help for closing costs, things of that nature. And I kind of will get into that. The biggest thing I want to stress when you decide to buy a home, this is a business transaction. So I would suggest you get all the information that you can to be able to afford yourself the best decisions that you could do, because I do not know what else you're going to buy that's anywhere from eighty to $250,000 besides a house. So the appreciation when you own a home can actually be passed down to your children's children, especially if the mortgage is paid off and the home is free and clear. They'll have a home to stay in, plus they have some equity to tap into. Oh, sorry, make that big screen. Give you an example. So if you were to purchase a home in 2010 and it was worth 100,000, on an average, if you do a 3% to 5% increase, the home would actually probably be more worth, since we're 11 years down the road now, we're probably close to 120, 122, depending where you are. So when the home appreciates, increase, it also increases your net worth. Your net worth is basically how many assets you have, things that actually have the money, your IRAs, your 401ks, money that you have in checking and savings account and equity in your home, and you subtract that versus everything that you owe, all your liabilities. That difference is your net worth. Having appreciation and equity in your home increases your net worth. Home ownership, it is a long-term investment. It's not a get rich quick scheme, but in investment properties, real estate, and insurance in the United States have made more millionaires than any other segment of business in our country. So the real cost of you renting versus you owning a home. So appreciation is something that you don't have the benefit in when you're actually renting a home. So, and these numbers are a little off now too, because the average median rent about 18 months ago, before COVID, was about 868 per month for like a two-bedroom house. That has actually jumped to about over $1,000 per month. But for this example purposes, if you were to pay this 868 a month for 5 years, you have spent $52,000 or given it away to that landlord. Usually what happens is that 868 a month goes toward your mortgage and you pay your mortgage down and you get the equity. In this case, you're just paying that money and it goes away. So assuming at a 4.5% interest rate, which is about a percent above what it is right now, you would actually build a little bit more than $30,000 in equity in that home in the same 5 year time period. So you go from, that's a pretty big swing, paying out $52,000 with no benefit versus you earning $30,000. The biggest benefit as well when you're financing a home is the tax benefits. So when you do home improvements, when you have the interest that is paid on the mortgage, that is tax deductible. There are all different kind of tax breaks you start to get when you own a home versus when you do not own a home, when you're renting. So interest rates and purchase price kind of go hand in hand. You're kind of at a sweet spot in time right now because interest rates are still at an all-time historic low. Um, Basically what that means for you, you're able to afford more of a home because the interest rate and payment would be lower than if the interest rate was 5, 6, 7%. So when rates go up, and eventually they will go back up to pre 2008 levels, which were around 5 to 6.5% around at that time, you would not be able to afford the same amount of home back then as you would now, because that interest rate and payment would affect your debt to income ratio more, because that payment would be more versus than what it is now. So is this a good time to buy a home? They say yes, for a couple reasons. Number one, the interest rate, the amount of money that you're going to pay back is going to be significantly less. Number two, the market has bounced back, but the prices still have not bounced back to a point to where they were in 2008 before, where things were kind of overinflated. So you can still get a home that's worth 150,000 or so that may have been worth 160, 175 back then. So there's a kind of double benefit to that. So with the interest that you pay on your home, you can deduct that interest annually from your taxes. They'll send you a statement. You provide that statement to your tax preparer, and you can deduct that along with property tax, any home improvements, things of this nature. As long as you kept the documentation and provided to your tax preparer, this can all increase or potentially increase your tax return each year. Getting into the actual qualification of the mortgage, whenever you apply for any type of credit or any type of loan, the very first thing that institution is going to want to do is get your personal information. Basically, your name, date of birth, social security number, copy of your ID, your employment information, and where have you stayed for the last 2 years. In some cases, they'll ask you for the I-10 number, and those for people that don't actually have a social security number, they have a number given to them by the IRS because they're quote unquote undocumented until they can have time to get their full citizenship. So this would be the first step in applying for a mortgage with us or any other lender. If you wanted to get a car, credit card, anything else like that, this is the first thing that they ask. What we're trying to determine is how much of a risk that you are and your ability to repay back this money if we were to lend it to you. So once we get this information, we're going to pull your credit. Once we get the credit, we're going to look at a couple snapshots, the last 12 months specifically, and then the history beyond that. So in the last 12 months, what we're looking for is how many late payments do you have? Do you have any collections, judgments, charge off, tax liens, bankruptcies? And then if so, why? So if anytime you have a lender that asks you for a letter of explanation to explain the debt, just saying, hey, look, I didn't have the money then, I didn't pay it, might not be the best route. So if you think about it this way, I'm a loan officer, and the person that actually makes the final decision on your loan is an underwriter. So she would be like the judge, or he would be like the judge. I'm kind of like your lawyer. I present your case, and I present all the good qualities about why we should be able to give you the loan. So that explanation, if they're on the fence about if it meets the guidelines, and they have this thing called underwriter discretion, means they can make a judgment call. Sometimes those letter of explanation either make or break you getting that loan, and I cannot stress that enough. So, and when you write the letter of explanation, whatever you say in it, if they ask you for a verifying piece of document, you better be able to have that verifying piece of document saying, I couldn't pay this because I was in the hospital between this time and this time. If they ever come back and ask for some hospital bills, it better correlate with the story that you have told. The two big things that we look for on here, collections and charge-offs. So it kind of goes in this order. You get an account, let's say you get a credit card, you have a balance of $1,000. You start getting behind on that payment of, let's say, $20, $30 per month. Once you hit the fourth month, or actually before then, they'll have you into internal collections where they're calling you to try to get the past due amount. Once they get to the point where they don't think internally they can't do it anymore, they'll probably send you to a collection agency, and the collections then may appear on your credit report. After some times go by and the collection efforts still are not good, the company may deem, hey, look, we don't think we're ever going to get money from them, and they do what's called a charge-off. Basically means, say, we don't think we're ever getting money from this debtor again. We're going to wipe it off the books and just count it as a loss. What can happen in between the collections and charge-off phase is you can get hit with a judgment, meaning in their collection efforts, they could actually petition the court to have you legally pay them back, either through garnishments or anything else like that. So if you're ever in a position where you get a letter saying you have to show up to court for any reason, for any debt, you want to make sure you show up to court, because they will do what's called a summary judgment. If you do not show up and your bill was $1,400 and that man says you owed him $15,000 and he's got some documents, the judge is going to say you owe him $15,000, and it's going to be a very hard fight to get that reversed. Bankruptcies, usually two types for personal individuals. There's a Chapter 13 and a Chapter 7. Chapter 7 is when you just basically say, hey, look, I can't pay anything back and I want to start fresh. A Chapter 13 is a repayment plan. So, along with the other debts that we're looking at for everything that you actually are paying on your credit report right now. Those would be car loans, student loans, whether they're in deferment or not. Like right now, everything's in mandatory forbearance. But us as a lender, we're still going to attribute a payment to that student loan, whether you're making a payment or not. And for some people, that can dramatically affect their debt to income ratio. For an example, I'll get this a little bit later. The two types of loan, FHA, conventional VA. Well, FHA, what most people qualify for, they take 1% of the outstanding student loan balance as a payment. So if you have a $50,000 student loan balance, we have to attribute a $500 a month payment to that, whether you're in an income-based repayment plan, whether your payment zero, no matter what your payment is, we have to attribute $500 to it. We also look at tax liens from the IRS, state level, child support, that is child support if you have to pay it, credit card debts, uh, other debt. Other debt would be like once we get your bank statement and we see something that's coming out each month, but it's not showing up on your credit report. Like some cars are buy here, pay here, but they don't report to the credit report. But we see something $330 coming out each and every month. We'll inquire what that is and we'll add that into your debt to income ratio. For recently acquired debt, there's going to be a section on your credit report that says all recent inquiries. And anything within the last 90 days, you have to explain why that creditor ran your credit and if any new credit was established. Reason for that, if you got a new car in January and I pulled your credit today, that new car payment would not show up on the credit report, but the inquiry would. I would have to ask you that question to know to put it into the debt to income ratio. So if you got into a contract and I said you could afford 180,000, but I didn't account for that new car payment, many times people have gotten under contract. The loan officer didn't ask them about something that was inquiry, got to underwriting, found out they had a new car payment, and now that messed to the debt to income ratio. They're no longer getting that $180,000 house. It's not that they can't be approved, it just won't be at the level of 180 because the debt to income ratio is so high. So another portion of the debt to income is the actual income. So we take all W-2 type salary, hourly, and salary, Social Security, disability, VA benefits, self-employment, pensions, annuities. We do actually count child support if it's going to continue for more than 3 years. That one I would put an asterisk by. If you are getting child support and you need that child support payment to make that mortgage payment, that's putting yourself in a very precarious situation. You're depending on somebody else making that payment on time that it won't affect your household budget. And then number two, that income is eventually going to expire. And how you make up that gap of that $200-300 a month you're receiving in child support to help make up your payment can sometimes be very difficult because studies have shown that most people file bankruptcy because they have a $350 a month deficiency in their budget, meaning they don't have an extra $350 a month. That's why they file bankruptcy. Child support is kind of in that same vein. If you're self-employed, the only way we can use the income is whatever you tell the IRS that you make based off your last 2 years tax returns, because we need 2 years tax returns, is the income that we use. So if you're self-employed and you say, I grossed $100,000, but I had a $15,000 loss because of all my expenses. Basically, you told the IRS, I got this business and I lost money. We would basically look at it the same way. If you told the IRS you lost 15,000, you effectively don't have income, and we wouldn't be able to do anything, even if you had a perfect credit score. Assets. So basically, assets is the money that you have and where. And why do you need this money for a purchase transaction? So there's a few components to this. Down payment would be the first one. So after you go
Hi,
through the
Chris.
process, yeah, go ahead.
I'm so sorry to break in, but I wanted to ask you a question before you moved over to assets. So I have a question about student loans.
Hmm.
You said you take the 1% of the balance. What if the borrower is currently a student? Do you still take the 1%, or is
Yep.
it is, even if they're a student on deferment, you'll still take
Yep.
any time that 1% is always counted in there.
If you're doing an FHA loan,
Okay.
that's for an FHA loan. So yeah, even if you're in school, we will take like I know people that are getting master's degrees and have like 90, $100,000 worth of student loan debt.
Mhm.
That's why if we can get you to a conventional loan versus an FHA, we would want to use that because conventional allows us to use whatever your income based repayment was, as long as we have documentation from the creditor saying, so let's say you had $50,000 in student loan debt and your payment was $25. With a conventional loan, I can use that $25 payment versus the $500 payment, which is going to give you a much bigger range of what you can afford because you have an extra $475 a month to attribute to a house payment.
Okay.
That makes sense?
Mm-hmm.
Okay,
Yes. Thank you.
no problem. Okay, so back to assets. So once you go through the pre-approval process and you get a letter, you have to show that you have all this money now as versus down the road. Because once you go find a home and you write a contract, the first thing they're going to do when they accept, they're going to ask you for the earnest money, which is going to be anywhere from $500 to $1,000. So this earnest money will be applied to your down payment. In most cases, the down payment required is anywhere from 3 to 5% of the purchase price. So if you were buying something for $100,000, and let's say you were getting a FHA loan, you would need 3.5% down of 3,500. So if you gave the earnest money of $500, that $500 would go towards that 3,500 that you need in down payment. The other thing that you would do right away after your contract is accepted is pay for inspections to be done on the home to make sure anything that's wrong with the property, you get a report that details it out. So you'll get a third party inspector, which is different than the appraiser. So the inspector is a third party that goes from the roof down to the basement and points out everything that's wrong on the home. Once you get that report back, you and your realtor get together and say, hey, seller, these things are wrong with the property. I either need you to fix these items, give me a credit for these items, or reduce the sales price. You guys negotiate all that out to make sure that whatever needs to be fixed gets fixed on their dime versus yours. The other thing that you need money for is escrows. This is your real estate taxes and your homeowner's insurance. An account has to be set up so when you make your monthly payment, we set up an account so 1/12 of your payment goes to your homeowner's insurance, 1/12 of your payment goes to your real estate taxes. So when that is ready to be paid, we can just do that. Um, let's see. Insurance is the only thing that you actually have to pay a year up front on. So if you were purchasing a house next week, you would pay your insurance premium for the year of 2021 until 2022, and it keeps going like that going forward. Closing costs. This is a separate cost from the down payment. So if back to that 100,000, if you're doing a FHA loan at 3.5%, the down payment required is 3,500. Closing costs are usually about 4.5% of whatever your loan balance is going to be. So that means you would need an additional, excuse me, of the sales price. So that means you would need an additional $4,500 if the seller was not going to pay it, or if you didn't have down payment or closing cost assistance. So without down payment assistance and closing cost assistance, this is why a lot of people really can't afford to get in a home because most people don't have an extra $7,500, $8,000 laying around. And then in some cases, you might have to have what they call reserves. Reserves is if your mortgage payment is going to be $750 per month, you have to show after you have paid your down payment, your earnest money, inspections, and escrows and closing costs, you still have 3 months worth of payments set aside somewhere in account just in case something goes wrong. Lenders always default to a worst case scenario. So you as a buyer, you're going to try to present your best case, but lenders and underwriters, they always default to a worst case. So sometimes those reserves are needed just basically, literally just in case. So the credit breakdown. Correct me if I'm wrong, Yvette and Carol, you guys have a credit class every Wednesday. Is that correct? I believe it's every Wednesday. They can share forward. It kind of goes in a little bit more detail into credit. So I'm gonna tell you this
Yeah.
way.
Yeah, sorry, I was trying to unmute myself.
Oh, okay. It is
Yeah.
every Wednesday?
Yes, every Wednesday at well, this month I think they're all at 11 o'clock in the morning. Sometimes we do 6 p.m., sometimes we do 11, but they're all on Prosperity Connections website. So we do Understanding Credit Part 1 and 2, and then we also have a little more specific class on using credit cards wisely, and then another class just all about how to read your credit report. So kind of what you have on the screen here, understanding your credit score, that's all stuff that we go over in that class as well.
Okay, good. Because
register on our website.
Cool. Because there are two credit models. So most everybody has a credit monitoring service, CreditWise, Credit Karma, things of that nature. Those models are for consumer-based lending, meaning if you wanted to buy a car, a credit card, anything on your personal side of your credit, and then we as mortgage lenders, we have a mortgage credit score that we go. They basically have two different set of algorithms and credit factors and risk that we have to determine what your credit score is. So a lot of people say, hey, look, my credit score on Credit Karma is 640. But when I pull it, it may be a 580. It may be a 660 or 670. And they're always asking me, why are there two different scores? That's the reason being because one is consumer based, one is mortgage based. The best consumer app out there to tell you what your consumer score is and your mortgage score is Experian. So they have a free service and they have a paid service. But the free service gives you everything that you need as well. And whatever your credit score is on that Experian account, within about 5 to 10 points, it's going to be whatever a lender pulls, whether it be for consumer or for mortgage. So if you want a service that actually helps you monitor your credit, I would say Experian. So in the pie chart, what the algorithms look at most to determine your score is number one, your payment history. How have you paid whatever loans that you got, whether it be student loans, car loans, credit cards, furniture, whatever. I know it's a little bit misnomer. The crazy thing is, I would much rather you miss a car payment than miss a credit card payment. Because if you miss a $30 payment, that is actually going to hit your credit worse that I've seen than if you miss a $300 car payment. Because what the algorithm comes up with and basically says what I've been told is you really couldn't come up with $30 a month. So if there's a choice of you missing a payment or something like that, miss a car payment. Do not miss those credit card payments if at all possible. The biggest chunk, the second biggest chunk after payment history is amounts owed. One big question we have all the time is my credit score goes up and down each month. If you have credit cards, this is probably the biggest reason why, because the amount that you owe versus your credit limits. So let's say you have a credit card that has $1,000 limit. Your credit score will drop if you charge over 30%. Will drop more if you charge over 50%. Will drop more if you do over 75%. Will drop more if you do 90% usage of it. So depending on how much you use, how much you pay, and then when that reports, it will have an effect on your credit report. And there's usually a 30 to 45 day lag of when it reports. So it's a good practice to find out when your credit cards report to the credit report each month, to know when to make your payment, to make sure that you make your payment before they actually report to the credit bureau, so you can get the biggest benefit. Then it goes to length of history. So you might have a good credit score, but you only have accounts open for 6 to 12 months. You really don't have a real history of paying people over time. So the longer the history that you have, the more stable your credit becomes. And then the last two are types of credit and then new credit. Types of credit would be installment loan, mortgages, student loans, or credit cards. So installment loans would be like a car. You know how much you borrowed, you know exactly how many months it's going to be paid off, and you know what your payment's going to be each month. Revolving is the credit cards where, depending on how much you use, the payment is compounded on the interest, or basically the payment is derived off the interest on the balance that you have. And then new credit, is it been there 1 month, 2 months, 3 months, 4 months, 2 years, 6 years? It has an effect on the score as well. The three credit bureaus that we use are Equifax, Experian, and TransUnion. And anytime you apply for a mortgage company, including us, we will pull all three. We will take the middle of the three scores. So let's say your Equifax score was a 620, your Experian score was a 680, and your TransUnion score was a 675. We would use the TransUnion score of the 675 because that is the middle of the three. And that's why I say the Experian website is the best, because you can actually get, for a cost, all three credit bureaus to kind of figure out what your middle credit score is. All right. So once we get past the credit, me as a lender, then I can then assess, based on the credit that I pulled, what loan programs are you available for based on credit. And they usually go into three buckets: conventional, government loans, and then specialty programs, which is a program that a bank specially has, that they'll lend their own money on and won't sell anywhere else. For a conventional loan, it minimally requires a 3% down for a first-time home buyer, up to 20% down if you didn't want to have mortgage insurance. So mortgage insurance is a mortgage that you pay to the lender anytime you borrow more than 80% of the value of the home that you're trying to purchase or refinance. This insurance has no benefit to you whatsoever. They put this money into a pool monthly in case of defaults, and it's a way to offset their losses because they deem it a riskier loan. Because if something were to happen and they had to foreclose on, and you had a mortgage balance at 95% of what you owe, they only have 5% to really get money out. But at 80%, they have 20% or more equity they can use to offset their balance. So that's why mortgage insurance is in place for any time you borrow over 80% of what you're trying to purchase or refinance. It used to be, before these times, conventional used to be a little bit lower, a better interest rate than FHA. But right now, they're pretty much on par. There may be an eighth of a percent difference, literally like 0.125% difference between the two that I've noticed. But most interest rates right now are around 2.875, 2.53% right now. But the biggest thing with conventional is they have a tighter box when it comes to underwriting guidelines, meaning foreclosures, you have to be 7 years out. Bankruptcies, you have to be 4 years out. You have to have at least 4 established lines of credit for at least a minimum of 18 to 24 months. Even though you may have a credit score that's 700, sometimes you might not get a conventional approval because all your credit is less than 6 months old or less than a year old. It's one of those things we have to put through an automated underwriting system. We call it AUS, to be able to determine if you qualify or not. With FHA, it's a 3.5% down payment. VA, it's 100% financing. So is USDA, it's 100% financing. So if you're eligible and you're a veteran or a surviving spouse of a veteran, if we can get you in a VA loan, that is what we want to do. USDA loans, if you want to move out in the rural country, basically out past Lake St. Louis, some places in Cotterville, things of that nature. FHA does have more lenient underwriting guidelines. If you had a bankruptcy, you have to be 2 years removed from the discharge date of the bankruptcy to be qualified. Foreclosures, or 3 years instead of 7 years. Short sales are about the same thing as well. They also have some looser guidelines when it comes to the credit score and the length of time that you have on the credit. The specialty programs is like what we have at our bank. It's called a portfolio loan, which basically means the bank itself is going to lend you the money. With conventional, it's backed by Fannie Mae and Freddie Mac. Government loans, FHA is HUD, VA is VA, and USDA is Ginnie Mae that they're backed by. But when you have a specialty program like at our bank, so if you're going to our no credit score program, People's National Bank will be the one actually lending you the money, and you would actually make your payment to People's National Bank. With these loans, we have all kind of down payment assistance that you can be layered with, along with conventional FHA and USDA. You can still get down payment assistance even though if you have 100% financing, because you can use that towards your closing costs. Our loan in particular, it kind of mirrors a conventional loan in the sense that it's a 97% loan, which means you only have to have 3% down. You can use it for purchases or refinances, but it has to be for your primary residence only. It's no investment properties. You can buy up to a 4-unit property with this as well. And as I said before, it's not based on your credit score. I look at your payment history. You will have to go through a first-time homebuyer education class and a budgeting class. But if you're getting down payment assistance, most of those make you do those same things anyway. So you wouldn't have to do 2 classes. You would just do one homebuyer education class, one budgeting class, and it'll satisfy what you need for the down payment assistance and us. The mortgage rates, they're fixed for 30 and 15 years, and the rate is pretty much on par with the FHA and conventional rates. It's not that much more. Your real estate taxes and your homeowner's insurance are mandatory. You have to make them a part of your payment. And that's kind of the case with most of the loans. A building inspection is required because on this loan, we want to make sure that you're not buying a property that's going to have problems in 2 to 3, 5 years. And we want to make sure that we're lending on a collateral that if anything goes wrong, there's no major problems with it. And then there's also a mandatory savings plans for emergency that comes along with our loan. When people buy a home, the biggest problem they have is maintenance on the property. 2, 3, 5 years down the line, the furnace goes out. The AC coil is bad. Things of that nature that you didn't plan an extra $2,000 to $3,000 to get fixed. The biggest difference between renting and owning a home is when you're renting, something breaks, you call the landlord, they come out and fix it, and that's it. When you own a home, you need to have a separate savings account for when stuff goes wrong, and it will, for maintenance and things of that nature that you are able to dip into. So this mandatory savings plan will be part of your mortgage payment and be part of your pre-approval process. So in 2 years' time, if the furnace goes out or anything else like that, you say, hey, look, I need to access these emergency funds. We verify that it's an actual need to get the home improved, and we'll issue it. Also, if something happens like what happened in COVID, when people got furloughed and they didn't have income, this savings plan will pay up to 3 months of your mortgage payment as long as you have it in there. So what happens is you pay into this savings plan for at least a year. You cannot tap into it until after the 12th month. But after the 12th month, those savings are there for you to use. So if the time goes on and you never have an instance where you need to tap into it to do any repairs, or because you are not off work, we can take that money and then apply it to the principal of the loan balance to pay it down or pay it off sooner. The qualifications for this program is you have to be 80% or below the median income of the census tracts. And this falls right in line with all down payment assistance program except for one that allows you to make a little bit more money. So it goes by household size and income. So basically, if you have a 4-person household, let's say it's you and your 3 children, and you make less than $65,000 a year, you're basically eligible for all the down payment assistance along with this program as well. Even if you didn't use this program, you would be eligible for the down payment assistance. Um, Most down payment assistance wants you to be a true first time homeowner, which means you have not owned a home in the last 3 years. But there is one down payment assistance program. If you owned a home within the last 3 years, you can still get assistance. It's just a little bit different process. This collections, judgments, and things of that nature goes back to that letter of explanation that I talked about earlier. All derogatory debt, no matter if it was 3, 4, 5, 6, 7 years old, will have to have an explanation of why that account was not paid. Basically, you want to take a look at where you were and where you're at. So you'll get a benefit once you go through that budget counseling. We can see the snapshot of your credit, where you were before, and how you manage your money with the bank accounts. Once you go through the counseling, we should see a difference in the habits on savings, how you pay your bills, everything else like that. I explain it to the people this way. So before you go to budget counseling, most people pay their utility bills. Ameren specifically when the yellow or pink bill comes, because yellow is okay right before disconnection. That pink bill means I got to pay it by this day and it's disconnected. What I've seen most of the time is after that fact, most people pay it before it even gets to that part. So the letters of explanations are very important. And for this program and really any other program, having return checks, bounce checks, or overdrawn accounts, no matter if it's FHA, VA, no matter what loan program you have, you're going to have to explain that. Because when you have bounce checks, overdrawn accounts, return checks, it's a sign of money mismanagement. So we need to get to the root of that to make sure we're not going to give you a loan that's going to increase the money mismanagement. Um, for all really loans, judgments and tax liens, they must be resolved, meaning they must be paid. Reason being is when you get a loan, there's going to be liens that are on title. Mortgage company in first lien position means we get paid first if anything goes wrong. Then if you have down payment assistance, they go second. While we don't, as lenders, don't like judgments and tax liens, sometimes those liens can supersede, mean go in ahead of us for them to get their money first, even though you owe us more money. So for judgments and tax liens, in most cases, they have to be fully paid before you can move forward. And a letter explanation is required as to why it became a judgment or a tax lien, why it wasn't resolved beforehand. So with this portfolio program, the seller can pay basically up to 6% of your closing costs. With FHA, that's the same. They can pay up to 6% of your closing costs and prepays. Conventional, they can only pay 3%. VA, they can also pay 6%. So the only program out there that'll only allow the seller to pay 3% is conventional. And the big difference is, let's say you want something for $100,000. Conventional, the seller can only give you $3,000, but FHA they can give you up to 6,000. Sometimes you might want to go with the FHA loan because you can get more assistance and have to come out of less money when the payment's virtually about the same. So we'll kind of look at all those things when it comes to it. You also, in most cases, for most loans and most down payment assistance, you have to have a minimum of $1,000 of your own money into the transaction. This is easily done by the $500 in earnest money, what you pay in inspections, and for the appraisal. There's one down payment assistance program to where it's a 3-to-1 match. So you put $1,000 in, they give you 3,000. You put 2,000 in, they give you 6, and it's fully forgivable in 5 years. In most cases, most people are going to have to outlay a minimum of $1,200 to $1,500 between earnest money, inspections, appraisals, and just other things on the home. So it makes sense just to pay that extra $500 to get an extra 3,000 of forgivable money. And we have to see these funds in an account before you're able to go out and shop. And that would be the same for a conventional loan, FHA loan, VA loan, no matter what type of loan that you get. So the next steps after that would be back to the personal information again. If you guys wanted to see where you're at in the loan process, working with me, I do what's called a soft credit pull first, which means it doesn't show up as a hard inquiry on your credit first, um, to kind of see what loan programs you may or may be available for right now. And if not, what we need to do to get your score there, or what needs to be done to put you on the road for your action plan for the non-credit score program. If you have over a 640 score or 640 or above, I will then do a hard inquiry, because then you possibly are eligible for the conventional loans, the FHA, USDA, VA, and all the other type of loans. Then we can kind of figure out, after the loan programs, about how much you can afford. A big thing I always tell people is you need to know your finances more so than we do, because if you're paying $750 in rent right now, do you want your mortgage payment to be more, equal, or less than what you're paying in rent? Us as lenders, we take your gross income to determine what you can afford. But since everyone pays their bills off of net, having that budget and going through that budget credit counseling is really going to be able to help you determine what your actual affordable payment is, once you take into account for how much you pay in gas, haircuts for the kids, if you got boys and they eat like crazy like mine, the grocery bills, all those different things, the account that we don't take into account when we're actually getting you qualified for a loan. That budget counseling would actually help drill down to the most affordable payment for you. I cannot stress enough, if you do not have a written budget, you need to have one, because life is going to happen. You need to have a plan written to know, hey, these bills are due on this date and this month. I can move this around to here. I can move this around to here. Especially if you have a significant other or married, you definitely need to have a plan to where you're together on the same plan, because there's no way I have seen anybody move forward financially in their life without having a plan together. You'll be on that hamster wheel doing the same things that you were doing 5 years ago if you don't make the changes. Out of everything that I've said here today, the budget, the budget, the budget, the budget, the budget is the most important thing. And if you do not have a written budget or know how to do one, Carol or Yvette at Prosperity Connection, that's why I partner with them. They are very good at doing that. But as far as the presentation goes, I'm pretty much done. If you guys have any questions, you can unmute yourself and ask me anything at this time.
Hey, Kris, I just wanted to mention that Prosperity Connection has a budgeting class once a month now, dedicated for budgeting, and it is generally the last Thursday of the month. We did a little swap this past month, but our next official budgeting class is March 25th. So
March 25th. Okay.
yeah, because we had a budgeting class last week, but we have one every month on the calendar, so people can check that out on our website as well.
What time?
Did you say what time? I'm
Yes.
sorry. Yeah, that one next month. I'm double checking. 10 a.m.
You don't have any in the evening?
We don't do the classes that our coaches teach. We generally do in the daytime, but you can also go to our YouTube channel, because we record those classes and you can watch them anytime. So if you go into YouTube and look up Prosperity Connection, all of the classes that we teach, we put up on up on YouTube, and you can watch it kind of at your leisure if you're not able to log in at 10 in the morning.
Thank you.
You're welcome.
Okay, so Kris, I had a question for you. You were talking about in order to qualify for the specialty law, that you have to be within a certain income base.
Yes.
Where can you find out the range?
So you can Google HUD median income, but because it goes by not only income, it goes by household size. So there's two components to that. So anybody over the age of 18, whether they're on the loan or not, they're going to consider their income as a part of that household for that down payment assistance. So, but if it's just one person over 18, then it's household size and income. So in most cases, 9 out of 10 people qualify for it because let me see, let me get it pulled up real quick so you can see it. Okay, so for St. Louis area, for a one person household, you have to make 46,450 or less. A two-person household, 53,000. Three-person household, 59, basically 60,000. Four-person household, you have to make under 66. And it goes all the way up to an eight-person household. Did anyone have any other questions?
I do have a question. I have a question about bankruptcy. Now,
Okay.
you said for FHA, you have to be out of bankruptcy for 2 years from discharge date.
That is
What
correct.
about what about for conventional? Is it the
4
same?
years
4 years from the discharge date or 4 years from the filing date?
from the discharge date. So from the date that it was actually finalized.
Okay. Thank you.
No problem. There's some other things that I always tell people. So a big thing, once you guys get qualified, I would suggest very much so that you write down a needs and wants list. Basically, everything that you need in a house versus everything that you want. So when you're walking a property, it's going to get very emotional. That list is going to help take the emotion out of it because it's kind of like dating. You know, my sisters came back to me with some dudes that had everything that they wanted, nothing they needed. I'm like, this is not gonna last because it's not what you told me you said you were needing. You know what I'm saying? I know you think he's cute and everything else like that, but I don't think it's gonna last because he got all the wants and nothing of the needs. And it's the same thing with the houses I've seen. So you want to take a look at the area, you know, school districts, you know, how your job stability is, and then the biggest thing, what sacrifices are you willing to make for home ownership? So let's say, you know, you're paying 750 in rent right now, and you say, yeah, I want a house payment of 1,000. You have to show you can make that payment before you get that payment. You don't have to prove that you have the ability to do that. And in some cases, the budget might have to take a tweak. And in most cases, for most people, it is um, eating out. You know what I'm saying? The eating out budget um, is a lot for most people. Okay, I seen your comment, Davida. We can talk about it. We'll talk offline. I think the income part, there's ways around that, depending on where you want to purchase. Okay, so I have a solution to that. I have a solution to that. Does anybody else have any questions for me? If you guys are talking, you guys are all on mute. So, all right. Well, if you guys don't have any questions, the next step is if you wanted to see where you're at, you can apply at my website, and I'm gonna throw it here in the chat for everybody. Okay, so I put in the chat my website to where you can go and complete an application. One thing I do want to mention, March 1st, there is going to be a change in loan applications on versus how loan applications are taken now versus going forward. If you do an application now, it's going to be a lot easier. After March 1st, they're going to ask you for everything but your firstborn. Yeah, and they still might ask you for a drop of blood or something, because right now the current loan application is 4 to 5 pages.
Mhm.
It can balloon up to 15 to 20 pages now. I was doing test scenarios for the last 2 days. Depending on how you answer questions, for a first-time person, it's not going to be that much different. You know what I'm saying? But if you've done applications before and you go in after March 1st, no matter what lender you go to, and you like, this is all different, that is the reason why. It's a federal mandate that they basically pushed off. It was supposed to go into effect last year, but COVID happened, so they pushed it off until March 1st of this year. So doing an application now versus in a week or two is going to be way easier. So I just put that out there.
You know what? I have another question for you. It was about you just said it's a seller's market right now.
Yeah.
I've been looking, just looking at the value of houses and all that good stuff, and it seems like homes have increased.
Mhm. Mhm.
Yeah,
They have
it's
because
really
of-
high right now.
because of COVID. So what happened when COVID hit? A lot of people realized where they were renting at, being stuck in, they didn't want to be there no more.
Mhm.
So they needed
Yeah.
to get out, especially if they was in an apartment or a small house with 5,
So
6
even
people.
though the rates are really low right now, is it smart to buy right now since everybody's inflating their homes?
Yes, because what happens is, okay, rates are eventually going to start catching back up and go up.
Mhm.
So eventually the home prices are going to be higher, and then the interest rate is going to be higher. So that means your buying power is going to dramatically decrease. Does that make sense?
That makes sense. Yeah, but it just doesn't make sense to me because it's okay. So let's just say, oh great, I can buy a $250,000 home right now. So I'm gonna go buy this $250,000 home at 2.5%, and I'm waiting for it to appreciate. I want to sell this home in 2 years. Does that make like
Appreciate. Yeah, and
you
unless
think
the bottom falls back out again, homes appreciate at about 3 to 5% a year. The only time we've seen it dip like that was when the crash happened in 07, 08.
But isn't that really questionable right now with COVID? Like we just don't know what's going to happen, you know? How
Yeah,
do
if
we
I
know
had a
to
crystal
appreciate
ball
things?
to know the future, I'd be so rich you wouldn't be talking to Chris Mills right now.
Yeah, I think I will be too.
But so all the factors and indicators, there's going to be a plateau, and it's kind of leveling off. The home prices depending on where you look at. So so there's also 2 segments. So there's homes that are on the market that are basically kind of move-in ready that you're seeing a frenzy on. But I work with a lot of investors that buy a lot of stuff that's off market and will renovate it, and then you could buy it before it actually hits the market. So that's a whole different bucket, because those guys, they never list them on the MLS and anything like that until the end user buyer wants to come. But those are a little bit more work to find. So you've kind of seen the fixer upper shows where they go buy the worst house on the best block. They used to be what they have renovation loans, 2 or 3K loans for FHA and conventional before COVID, that if the home needed 20, 30,000 repairs, we could finance that in. Nobody's just really doing it right now. So it just kind of depends on, number one, area, number two, the quality of homes in that area, and then number three, can you find something that's off market that needs a little bit of work, that either you have the money yourself to put in, or we work with an investor to get you the money to put in, and he sells it to you as if it was already rehab. Does that make sense?
Yes, that does make sense.
Okay. So the timing thing, it's kind of like double dutch. You know what I'm saying? You kind of waiting for your time to get in, and you're seeing how the longer you wait, the more expensive it's going to get. That's one thing I do know. The longer you wait, the more expensive it's going to get.
Okay.
because since the election, rates have went up about 0.5% to 0.75%, and it does that about just about every election. But um, they can't keep it this artificial. Well, I've been saying that for the last 15 years. I'm gonna stop saying that.
Uh-huh.
I'm gonna keep saying they can't keep rates this low. It ain't gonna go. It ain't. And rates has been. I've been doing this for. My son is 20 years. Um, and when I first started doing this, you can have an 800 credit score with 20% down. Your interest rate was 8.75,
Whoa.
and that was with perfect credit and 20% down. So, people complaining about a 3% interest rate. I'm like, y'all better go on somewhere. It's crazy, but yeah. So if you guys, I know me and Davida have spoken before, but anybody else, I would suggest you guys get the application in so I can do a soft pull just to kind of see where you're at, kind of give you some information and game plan to where to go from there. Then connect you with Carol or Yvette so they can put you into the proper classes to get you moving forward. You got anything else, Miss Yvette?
I don't. Carol, does anyone have any other questions?
I think I'm good.
All
Just
right.
again,
Well,
for people to, go to the website or call us and we can get you connected. I look a little different than my picture. I went running today.
yeah, and next time I'll get it figured out because I got I got a whole bunch of emails of people that were trying to get in, and I did it, and by the time they saw the email so I'll get that figured out by next time. I realize.
So I think the link, because I looked at it, and this is Reese talking. I looked at the link. I actually emailed. I'm like, hey, how do I get in? The link said it was for like January 19th. So I kept clicking on it, and it would not let me in. But then you sent a completely different link, and that let me in.
So
It's
It
changing
just
the
kept saying
link.
it was invalid.
so the link that you got on the order form was back from January?
The link that's on the order form, when it sent me the email, it said home buyer workshop is going on now, and it said join. The link that I had to click on for join, the date on there was January the 19th. And I figured that was the issue. So that's why I think I couldn't get it.
Because
I mean, it
when I
had the
did a
date
test,
of today.
That's so weird.
That
Yeah,
is-
it had
Yeah.
the date, the February 23rd date for the link. I mean, for the event. But then when it said join the event, that link, it had January 19th.
so I'm doing something right now. I'm trying to look at, okay, so the link that was sent out on the thing. Yeah, so I'm looking on the order forms that went out. What was your name? I'm sorry again.
It's Reese. And I'm looking at it right now. It says Zoom meeting, free home buyer workshop, Tuesday, January 19th, 2021 at 6 p.m. Central Time. Free home buyer workshop join meeting.
Yeah, I'm looking at the link that's on there, and it's the same one that's on this Zoom call. It says meeting ID 825-9004-6859.
It never showed me the link. It only gave me that orange button to join. So when I hit join, it went into my app.
So yeah, so I see it says the one that says view event, but if you scroll all the way down at the bottom, it gives you the actual link, and that's what a lot of people, I don't think they're. I put in instruction. Look on your. So if you scroll all the way down, you see that join Zoom meeting link.
So that's the thing. I'm in the email and it says view the event, the orange button. I click view the event, and then it takes me to Tuesday, February 23rd, 2021, free home buyer workshop. And then it says event details. I click on event details.
Button, yeah, the view event button in Eventbrite is wrong. It's not linking up. Because if you scroll down, right up under that orange one where you see free home buyer workshop, if you scroll down all the way to where it says additional information.
That's where I am. And it says join meeting, the Zoom meeting. But the date on Zoom meeting, free home buyer workshop, says Tuesday, January 19th That's what it says for me.
If you could forward that to me, I would greatly appreciate it because I got to figure out what is going on. Because I did a self-register myself, and
Yeah,
when I
I
tried to
will.
click on that orange button, it didn't work. But when I clicked on, I went back to the original order form, and then it worked then. But I got to get that figured out because that's crazy. I got a lot of people that's mad at me right now.
Yeah, I was like, I sat at home waiting for this meeting and I can't even join. What?
Right. I got a lot.
I
I
didn't
got. I
expect to
got.
get a reply back.
I gotta. I gotta make a lot of makeup calls. I'm sorry. I'm sorry, bro. I'm sorry. I'm sorry. I'm married 25, 30 years. I'm used to saying I'm sorry. I'm a guy. So okay. Thank you. Okay, that helps out. That orange button, that view event thing is. I gotta get rid of that.
Mhm.
Yep. I gotta figure out how to get rid of that because that's 2 in a row now that it's done it to me on. Okay. Well, everyone, I thank you for your time. If you guys got any questions, you got my contact information on the emails. If you need anything from Yvette and Carol, visit prosperityconnections.org. Is that correct? The
Yes.
.org?
Yes.
Yes.
.org. Yep. All right. I hope
Okay,
you
so
guys
Kris,
have a good evening.
when would you like to?
Thank you.
Give me a call tomorrow, Davita.
Okay. What's a good time?
Anytime. Let me see. Hold on. Let me see. Let's pull up my calendar. I gotta do them test things. Give me a call after 11. I should be done with all my test cases and stuff like that.
Okay. Talk
And
to you.
we can try to figure out about your particular situation.
Okay, thanks. Have a good one. Have a good one,
No
everyone.
problem.
Bye.
Bye.
Have a good evening, y'all. Bye bye.
So Chris, I'm looking at April. I think it's a May class. I'll send you the date